Hey, it's Nathan with optionsforall.com. In this video, we're going to be discussing debit spreads. So there's a bull call debit spread and a bear put debit spread. So we'll go over both of them in this video. We're going to go over some definitions and explanation of what a debit spread is. Then we'll hop over to Robinhood and go through a few examples, and we'll look at Robinhood Legend as well, and I'll show you how to set up those trades over there. So real quick, let's go over to the handy dandy cheat sheet that we have, link in the description down below. So in this video, we're talking about these two vertical spreads. We have the bull call spread, which is a debit base spread, and you want to place this when you are bullish on a stock. So you want the stock to go up in this particular case. And then we're also going to be discussing the bear put spread, and it's also a debit spread. And this is if you're bearish on a stock, like you think the stock's going to go down. So here's how to set it up. Buy to open one call at one strike price, sell to open one call at a higher strike price, and then to close out of it, you just do the opposite. You sell to close the one call and you buy to close the other call. And then with the bear put spread, you buy to open one put at a higher strike price and sell to open one put at a lower strike price. And to close it, you just do the opposite. And we're going to go through some examples, so all that stuff will make sense in just a second. So what is a debit spread? A debit spread is an option strategy where you pay a net debit, so a cost up front, to enter the trade with limited risk and limited profit. So you have to pay money up front to open this particular trade. It's built using two options of the same type, so you do both calls or both puts, depending if you're doing a bull call debit spread or a bear put debit spread, and it has the same expiration but different strike prices. A call debit spread is a bullish trade using two call options. A put debit spread is a bearish trade using two put options. So in both cases, you buy one option. This is the main directional bet. So buy one, which is the way you want the stock to actually go, and you sell another option further out of the money to reduce the cost. And you'll see that as we go through the examples. Now, because you're paying more for the option you buy than you collect for the one you sell, you end up with a net debit, which is why it's called a debit spread. So you're paying money versus a credit spread where you're getting money up front. You're getting that premium up front. Now, why use a debit spread instead of a single option? So this is like an alternative to using just buying calls or buying puts, because buying calls and buying puts can be pretty expensive. And by doing a spread, you can reduce that cost, but you're also limiting your potential profit. So buying a single call or put can be expensive, like I just said, and very sensitive to time decay and volatility. A debit spread lowers your cost by selling another option against it. It limits your risk to the amount you paid and smooths out some of the impact of time decay and volatility changes. And that's because you have a long option and you also have a short option. So when one goes up, the other goes down, and kind of smooths things out for you along the way. Now, you do give up some maximum profit in exchange for cheaper, more defined risk trades. So you will see that you don't have like unlimited profit potential when you do these trades, but you can still make a good chunk of money with a defined risk amount. Now, when to use debit spreads? You typically use debit spreads when you have a directional opinion. So you're either bullish, so you're going to be doing a call debit spread, or you're bearish and you do a put debit spread. You expect a moderate move in the stock, not necessarily a huge explosion. So you do want the stock to move. Like, this is not a neutral strategy, but you're also not expecting it to like jump to $1 million or crash down to $0 as well. You want to find risk and are okay with cap profit. The options aren't cheap enough to justify for a naked long call or put, or you want a more cost-controlled approach. So these types of trades can be good for smaller accounts, like if you only have a few $1,000s in your account, you can do debit spreads, even with small accounts. Now, debit spreads are a great fit when you're saying, I think this is going up, down by this much, rather than, I think this is going to the moon or crashing to zero, depending if you're bearish or bullish. So how to set up a call debit spread when you're bullish? Here's a simple way to build a bullish call debit spread. You choose your expiration, pick a single expiration date that matches your time frame for the move, usually around 30 to 60 days, so that way you have time to adjust. And it also reduces the risk for early assignment. And the next step is to buy a call option. So choose a strike price near or slightly in the money. This is your main bullish position. So you'll buy it, and then you sell a higher strike call. So pick a strike above the current price where you'd be happy taking profit if the stock reaches it. Selling the options at this strike will bring in the premium and reduce your cost of the long that you put in. Then you want to check the net debit and spread width. So the net debit is what you paid, is your maximum risk, and the spread width minus the debit is your maximum profit. And you'll see that when we go to Robinhood, they show it to you. So it's pretty easy to calculate and see what's going on. Now, how to set up a put debit spread, so when you're bearish. So the opposite of the call debit spread when you're bullish. So for a bearish put debit spread, you flip the direction. You choose the expiration, so same idea, match your expected time frame for a move down. You buy a put option, so you choose a strike near or slightly in the money, below the current price, or just out of the money. And this is your main bearish position. And then you sell a lower strike put, pick a strike further out of the money, so lower down in price, near where you think the stock could potentially fall. This helps reduce the cost of the trade. And then you check the net debit and spread width. So the amount you pay, so your debit is your maximum loss. The distance between the strikes minus the debit is your maximum profit. Again, Robinhood will calculate this for you. So how debit spreads make and lose money. You make money when, for a call debit spread, the stock moves up toward or above the short call strike by expiration. For a put debit spread, the stock moves down toward or below the short put strike by expiration. And in both cases, the ideal scenario is that the stock finishes beyond your short strike, so the spread is worth the maximum value. And you lose money when the stock doesn't move enough in your direction or moves the opposite way. If the stock finishes below your long call strike for call spreads or above your long put strike for put spreads, the spread can expire worthless and you lose the debit you paid. And so that's your maximum loss if the stock doesn't move up or down like you think it will. And your maximum loss is the net debit paid, and your maximum profit is capped. Now, the pros of debit spreads, they are defined risk. You know your maximum loss going in. It's the debit you pay. You lower the cost than buying a naked option, so selling the second option helps reduce your entry cost. It's a directional trade with control, so you can express a bullish or bearish view without tying up huge capital. Like I said, this can be a good trade for smaller accounts. And less impact from volatility and time decay compared to that of a single long option, because the short leg offsets some of that. Like I was saying, if your long leg starts going the wrong way, your short leg will kind of make up for that and kind of dampen that volatility. So cons of debit spreads, so trade-offs to be aware of. You have capped profit. You give up unlimited upside in exchange for lower cost and defined risk. And that's comparing simply buying a long call option where you have unlimited profit potential, but it's also more expensive to do that. Another con is that you generally need the stock to move in your direction within a certain time frame. So it is either a bearish or bullish strategy. It's not really a neutral strategy. You don't want the stock to kind of stay flat. You need it to go up or you need it to go down. And then if the move is too small or too slow, you still might lose even if you were right in the direction. And there's more moving parts than a single call or put, so you need to understand how both legs behave. So it's a little more complicated, but it's not that hard to understand. Real quick summary, a debit spread is a directional, defined risk option strategy where you buy one option and sell another at a different strike, paying a net debit. Use call debit spreads when you are bullish and put debit spreads when you are bearish, accepting limited profit in exchange for limited risk and lower costs than buying a single option outright. All right, so let's go ahead and head over to Robinhood and we'll set up a few of these trades. So here we are in Robinhood, and I'm going to go to my ticker symbol, and I'm just going to use the IBIT Bitcoin ETF. And I'm going to go ahead and click on the Trade IBIT options right here. And I'm going to go out about 30 days or so. We'll go December 19th, 33 days. And we'll go ahead and do a bull call debit spread first. So in this case, we want the stock to go up in price. And so the first leg we're going to buy is the long position. And let's go ahead and choose a strike price that I think that IBIT's going to hit by December 19th, so 33 days from now. Now we can see that the current price is $53.91, and I'm thinking that it's going to bounce back up, and I feel pretty confident that it's going to hit the $56 mark by December 19th. Now, if you watch some of my other videos, I usually go to like a 0.2 delta when I'm looking at particular options to go ahead and trade. But usually with debit spreads, I'm closer to in the money or sometimes even in the money. So you can kind of play with the numbers and see where you're going to wind up. Of course, the further out of the money you go, the cheaper the options are, but also the chance of profit goes down the further out of the money you go. So when it comes to these debit spreads, I might actually do some like technical analysis and look at resistance levels and things like that. And so let's just say that I did that, and I feel pretty confident that IBIT's going to bounce up and be above $56 in the next 33 days. So I want to be on buy, and I'm buying my call, so I'm opening my long position, and I'm going to go ahead and add that to my order. So right now we're simply buying a call option, and we can see what's going on. We're buying the 56 call for $2.53 or $253. And so we can see our max profit right here is unlimited. So if Bitcoin or IBIT ripped to $10 million, well, I could capture all that upside by simply buying this call option. However, my max loss is $253. So I got to spend $253 to buy that particular call option. And you can see the break-even price of $58.53. So if we look at this little graph right here, we can see anything under $56, I'm going to lose all $253. And then as I approach my break-even price, I lose less money up until I get to my break-even price of $58.53. And then I can start making money, and the money potential goes up to infinity. Now let's say that I don't want to risk $253. Also, the likelihood that it's going to rip to $10 million, isn't that high. So even though it says unlimited max profit, like the likelihood of that actually happening is pretty low. So what we want to do is set up a debit spread. Now I need to go ahead and sell a call option, and it needs to be further out of the money. So let's say that we'll go $3 difference. So from 56 to 59, and we'll go ahead and add that to our order. All right, so now I'm buying the 56 call, selling the 59 call. We can see my cost is $105 or $105. And now we can come on down here and we can see that my max loss is $101. And so I've reduced my max loss from the $250 some to only $100, but also my max profit is only about $200 instead of the unlimited amount. But realistically, maybe the $59 point is at a point of resistance, and I don't think that the price of IBIT's going to go past that anyway. And so it doesn't really make sense to go even further out of the money and thus increase my max loss potential. So let's just do it for the sake of example. So let's say I bumped it up to 61. So now we can see my max loss is $146. And sure, my max profit went up, but I don't think that it's going to go past $59 anyway. So what's the point of selling the $61 call when I don't think it's going to go up there anyway? And so hopefully you can kind of see that there's some strategy here, just going way deep out of the money and buying this because, yeah, you can maybe make more money because your max profit is way up here, but the likelihood that the stock is actually going to go that high, could be very, very small. And so you're trying to balance your risk versus reward when you're doing these trades. Now, one key piece of advice that people go by is a 2-to-1 trade. So right here is perfect. So max profit $200, max loss 100. So 2-to-1 profit to loss ratio is considered a good starting position. So that could be something to keep in mind if you're opening these types of trades. All right, so that's the call side. Let's go ahead and do the put side real quick, and we'll go faster because I think I hit on a lot of the key points that I wanted to. So now we're on buy, and we want to buy our long put, and now we'll stay out of the money just a little bit. We'll go to 51. So in this case, I'm bearish on IBIT, and I think it's going to drop from 53.91 to 51 or less by December 19th. So I'm going to go ahead and buy my long option, my long put option right here. And we can see that my max profit is $4,876. That's if IBIT crashes to $0. My max loss is the debit that I'm paying for that put option, which is $224. And I don't want to risk $224. Plus, I don't think that IBIT's going to go to $0 anyway, so why leave it wide open like that? Let's go ahead and lower our maximum loss potential while also decreasing our max profit potential. But again, I don't think IBIT's going to 0 anyway. So let's go ahead, we'll do 51, and we'll just do the 48, so a $3 spread. And in this case, we're shorting the put option, so I need to go to sell. So we'll go with the 48, and we'll add that to our order. So we're buying the 51 put, we're selling the 58 put. Our total cost is $89. We can see our max profit is $217, max loss is $83, and our break even is $50.17. And so that's how you go ahead and set up a bear put debit spread. Now let's hop over to Robinhood Legend, and I'll show you how to set up these trades over here. And this will be a pretty quick segment. All right, so let's go ahead and switch to our IBIT ticker symbol, and we wanted to go to December 19th right here. So we'll open up that options chain. All right, so we're on the call side right now. So we'll do our call debit spread. So let's come up here, and we want to go with $56. We're going to go ahead and buy the option. So on the ask side, the green one, we're going to go ahead and buy. And then we're going to go $3 more up. So we're at 56 to 59, and we're going to go ahead and short it. So we'll click on the red option or the red numbers here under the bid column. So we'll short it. And so we have our IBIT call debit spread. And we can see that we're buying to open the 56, selling to open the 59. And we can see our maximum profit of $199, max loss $101. So there's our 2-to-1 ratio right there. Now let's go ahead and get this off of here, and we'll go to the put side. We're going to go slightly out of the money, and I want to go ahead and buy the 51 put option right there. And we want to go ahead and we'll go $3 more down in strike price, and we want to open up our short position. So we're going to be selling the 48 put option. So we're going to click the red numbers or the bid column, and we can see that we have an IBIT put debit spread now. We are buying to open the 51 put, selling to open the 48 put. Our max profit is 216, max loss at 84. And so now what we want is the price of IBIT to be less than $50.16 by December 19th. Ideally, we want it less than $48, so that way we get our maximum profit, which is the $216. And so that's it for trading debit spreads. I hope you found this video helpful. If you did, I appreciate it. Towards the likes, comments, subscribes, anything like that. And I hope you have a great rest of the day.